Hi, I'm Mark Farber, and this is Accounting Fundamentals. Today what we're going to do is we're going to take the transactions that we put into the journal in the last video, and we're going to post them to the ledger. Now remember what we said, when we put the entries into the journal, and I've abbreviated them over here, we can see the first one was a debit to cash of $5,000, credit to capital, debit equipment $2,000, credit cash $2,000, so on and so forth. Those are the 5 transactions that we've been looking at so far. The problem that we have is that if you wanted to know how much cash the company had, you'd have to go through and start saying, okay, well, here's a debit to cash, so that's plus 5,000, and here we've credited cash, so that's minus 2,000, so that's 3,000 net. And then we credit cash 2,000, so I'm down to $1,000 of cash. Well, again, imagine doing that for a really big company. You're working at Apple, and somebody says, how much cash do we have? And you have to go through a list of millions of these things to figure out how much cash the company has. So we need a way of keeping track of it. And the way that we do it is in a bunch of accounts called the ledger. Now, you can go and look at what an actual ledger account looks like when it's formally written. But one way that we keep track of ledger accounts is using T accounts. Remember, we looked at those before. And we have a T account for each one of our accounts. So cash, accounts receivable, equipment, rent expense, revenue, etc. And what we're going to do, all that posting means, is it means that we're going to take the information in our journal and we're going to record it in the T accounts. And you'll see how that allows us to keep track of how much we have. So let's go through very quickly and do that. The first transaction, we have a debit to cash of $5,000. So debit, remember, is the left side of the T account. So I'm just going to put 5,000 over here, and I'm going to put a little 1 next to it. And that corresponds to this being transaction number 1. Just in case I want to know where that $5,000 came from, I can always go back to my journal and see that it was transaction number 1 and it referred to this transaction over here. Then we have a credit to capital of 5,000, so we have to be really careful. Okay, credit is on the right-hand side, 5,000. And again, I'll put a little 1 there, just to note that it's transaction number 1. And then I check it off to show that I've done it. And we just keep doing that. So debit equipment, $2,000, 2,000. And I'll put a little 2. And credit cash, $2,000, 2,000, and a little 2. Nothing harder than that. That's all that posting is, really. And in fact, in a computerized accounting system, when journal entries are created, they tend to get posted immediately. But in the old days, when this was all done with paper and pencil, you had to go through this process. So debit rent expense, $2,000. So we'll find our rent expense account, $2,000. And that's transaction 3. And credit cash, $2,000. So again, on the right-hand side, 2,000. That's a number 3. Debit, check it off. Debit accounts receivable, $3,000. So it's over here. I'm just going to write it down here just to give myself some room. And that's transaction number 4. And credit revenue, $3,000. Transaction number 4. Check it off. And then finally, we're going to debit withdrawals, 500. And we're going to credit cash, 500. Okay? And now we've posted all of these. Well, we can now kind of ignore this. It doesn't go away. It stays there in the journal. But now we can focus our attention over here. And we can see that accounts receivable, there's $3,000. We can very quickly see that the company has $3,000 owing to it. It has $2,000 of equipment. It's earned $3,000 of revenue, and so forth. And generally, there'll be a lot more transactions than just 1 in a T account. So what we do when there's more than 1 is we draw a line at the point that we want to calculate how much we have of a particular account. In this case, we'll do cash. And we add up the left side, 5,000. And we add up the right side, so 2,000, 4,500, 4,500. So it's $5,000 of debits and $4,500 of credits. And then what we do is we subtract the smaller number from the larger one. So 4,500 we're going to subtract from 500. That gives us a net amount of 500. And we write it, we create another line, and we write it on the side of the larger amount. So because there was more debits than credits, what we say is that we have $5,000 of debits minus 4,500 of credits leaves a balance of $500 of debits. In other words, the company has $500 of cash, and we can see that very easily from our ledger accounts. So now that we've seen how we do ledgers, what we need to understand is, okay, remember what we said, the accounting equation always has to be in balance. We knew it was in balance here because for each transaction we can see the debits are equal to the credits. Of course, over here we can't see that anymore. Here's a credit of $3,000, and unless you want to go looking through all your accounts to find the corresponding debit, which is over here, then you'll never know if you're still in balance or not. What if you made a mistake? We can't afford to make mistakes here. So what we're going to see in the next video is how we reconcile that, how we make sure that once we've copied everything over to our ledger accounts and we've calculated the balance in each of these ledger accounts, how do we make sure that it's still in balance, that the accounting equation still holds? And we'll see that in the next video.